Faced with the task of rebuilding public infrastructure including roads, ports and airports, water and sanitation systems, government facilities and institutional frameworks, Timor-Leste has made significant progress in key areas since independence. Meanwhile, fragility remains a challenge as the country contends with the legacies of past conflict. The economy of East Timor is a low-income economy as ranked by the World Bank. It is placed 133rd on the Human Development Index, indicating a medium level of human development. 20% of the population is unemployed, and 52.9% live on less than $1.25 a day. About half of the population is illiterate. East Timor continues to suffer the after-effects of a decades-long independence struggle against Indonesia, which damaged infrastructure and displaced thousands of civilians. The economy of Brunei, a small and wealthy country, is a mixture of foreign and domestic entrepreneurship, government regulation and welfare measures, and village traditions. It is almost entirely supported by exports of crude oil and natural gas, with revenues from the petroleum sector accounting for over half of GDP. Per capita GDP is high, and substantial income from overseas investment supplements income from domestic production. Brunei's economy is almost totally dependent on the exploitation of its vast reserves of petroleum and natural gas. Although oil and gas revenues have allowed the state to give its citizens one of the highest per capita incomes in Asia, they also have made the country dependent on a single commodity that is subject to market fluctuations. In addition, Brunei must rely on imports for nearly all its manufactured goods and most of its food. To ensure the country's economic stability, the government has since the late 20th century striven to diversify the economy by developing other sectors, such as agriculture, fisheries, tourism, and financial services. The economy of Laos is a rapidly growing lower middle income developing economy. Being one of 4 remaining socialist states along with China, Cuba, and Vietnam, the Lao economic model resembles the Chinese socialist market and/or Vietnamese socialist-oriented market economies by combining high degrees of state ownership with an openness to foreign direct investment and private ownership in a predominantly market-based framework. In the current period, the economy of Laos relies largely on foreign direct investment to attract capital from overseas to support its continual economic rigorousness. The long-term goal of the Lao economy as enshrined in the constitution is economic development in the direction of socialism by creating the material conditions to move towards socialism. Despite rapid growth, Laos remains one of the poorest countries in Southeast Asia. A landlocked country, it has the inadequate infrastructure and a largely unskilled workforce. Nonetheless, Laos continues to attract foreign investment as it integrates with the larger ASEAN economic community, due to its plentiful, young workforce and favorable tax treatment. Over the past 2 decades, Cambodia has undergone a significant transition, reaching lower middle income status in 2015 and aspiring to attain upper middle income status by 2030. Driven by garment exports and tourism, Cambodia's economy has sustained an average annual growth rate of 7.7% between 1998 and 2019, making it one of the fastest growing economies in the world. However, Cambodia is experiencing a resurgence of COVID-19 cases, which has slowed the recovery, especially of the service, construction, and real estate sectors. The growth projection for 2021 is now revised down to 2.2%, despite strong export performance supported by improved external demand conditions. Cambodia's outlook remains highly uncertain and risks are tilted to the downside. Despite accelerated vaccination progress, the risks of a protracted COVID-19 outbreak and further disruption remain high. Currently, Cambodia's foreign policy focuses on establishing friendly borders with its neighbors such as Thailand and Vietnam, as well as integrating itself into regional ASEAN and global WTO trading systems. Myanmar's economy, based on the kyat, is one of the least developed in the region. Much of the population is engaged directly in agricultural pursuits. Of those who are employed in other sectors of the economy, many are indirectly involved in agriculture through such activities as transporting, processing, marketing, and exporting agricultural goods. The military coup in Myanmar in February has reversed or put at risk a decade of gradual economic progress. In the last decade, the Myanmar economy benefited from significant economic and political reforms, achieving above 7% annual growth, reduced poverty, and a significant increase in international investment. These gains are being unwound by the impacts of the COVID-19 pandemic and, more so, by the coup, with the World Bank forecasting a 10% contraction in GDP in 2021 and the UNDP warning of a possible doubling of the poverty rate. The economy of Singapore is a highly developed free market economy. Singapore's economy has been ranked by the World Economic Forum as the most open in the world, the third least corrupt, and the most pro-business. Singapore has low tax rates and the second highest per capita GDP in the world in terms of purchasing power parity. Alongside the business-friendly reputation, state-owned enterprises play a substantial role in Singapore's economy. The sovereign wealth fund Temasek Holdings holds majority stakes in several of the nation's largest companies, such as Singapore Airlines, Singtel, SD Engineering, and MediaCorp. The Singaporean economy is a major foreign direct investment outflow financier in the world. Singapore has also benefited from the inward flow of FDI from global investors and institutions due to its highly attractive investment climate and a stable political environment in recent years. The country's main exports include electronics, chemicals, and services. Singapore is the regional hub for wealth management. To preserve its international standing and to further its economic prosperity in the 21st century, Singapore has taken measures to promote innovation, encourage entrepreneurship, and to retrain its workforce. The economy of Vietnam is a socialist-oriented market economy. Vietnam is in a period of being integrated into the global economy. In the current period, Vietnam's economy relies largely on foreign direct investment to attract capital from overseas to support its continual economic rigor. Vietnam's development over the past 30 years has been remarkable. Economic and political reforms under Doi Ngoc, launched in 1986, have spurred rapid economic growth, transforming what was then one of the world's poorest nations into a lower middle-income country. Between 2002 and 2018, GDP per capita increased by 2.7 times, reaching over $2,700 in 2019, and more than 45 million people were lifted out of poverty. Poverty rates declined sharply from over 70% to below 6%. The vast majority of Vietnam's remaining poor, 86%, are ethnic minorities. Given its deep integration with the global economy, the Vietnamese economy has been hit by the ongoing COVID-19 pandemic but has shown remarkable resilience. GDP grew by 2.9% in 2020. It was one of the few countries in the world to do so, but the crisis also left a lasting impact on households, with 45% of households reporting lower household income in January 2021 than in January 2020. Vietnam's economy is set to grow 6.6% in 2021 on the back of successful control of COVID-19 infections, strong performance by export-oriented manufacturing, and robust recovery in domestic demand. Since gaining independence in 1957, Malaysia has successfully diversified its economy from one that was initially agriculture and commodity-based, to one that now plays host to robust manufacturing and service sectors, which have propelled the country to become one of the leading exporters of high-tech products, electrical appliances, electronic parts, and components. Malaysia is one of the most open economies in the world with a trade-to-GDP ratio averaging over 130% since 2010. After the Asian financial crisis of 1997 to 1998, Malaysia's economy has been on an upward trajectory, averaging growth of 5.4% since 2010. However, the COVID-19 pandemic has had a major economic impact on Malaysia, particularly on vulnerable households. Having revised its national poverty line in July 2020, 5.6% of Malaysian households are currently living in absolute poverty. The government is focused on addressing the well-being of the poorest 40% of the population. To fully realize its human potential and fulfill the country's aspiration of achieving the high-income and developed country status, Malaysia will need to advance further in education, health, nutrition, and social protection outcomes. Key priority areas include enhancing the quality of schooling to improve learning outcomes, rethinking nutritional interventions to reduce childhood stunting, and providing adequate social welfare protection for household investments in human capital formation. The Philippines has been one of the most dynamic economies in the East Asia-Pacific region. Average annual growth increased to 6.4% between 2010 to 2019 from an average of 4.5% between 2000 to 2009. With increasing urbanization, a growing middle class, and a large and young population, the Philippines' economic dynamism is rooted in strong consumer demand supported by a vibrant labor market and robust remittances. Business activities are buoyant with notable performance in the services sector including business process outsourcing, real estate, tourism, and finance and insurance industries. The COVID-19 pandemic and community quarantine measures imposed in the country have severely impacted economic growth and poverty reduction. Growth contracted significantly in 2020, driven by heavy declines in consumption and investment growth, and exacerbated by the sharp slowdown in exports, tourism, and remittances. Nevertheless, the economy has started to recover with a 3.7% year-on-year expansion in the first half of 2021, buoyed by public investment, and a recovery in the external environment. With continued recovery and reform efforts, the country is getting back on track on its way from a lower middle-income country to an upper-middle-income country in the short term. Economic growth is expected to further rebound assuming a containment of the virus domestically and globally, an acceleration of mass vaccination pace, and more robust domestic activity bolstered by greater consumer and business confidence and the public investment momentum. Over the last 4 decades, Thailand has made remarkable progress in social and economic development, moving from a low-income to an upper-middle-income country in less than a generation. As such, Thailand has been a widely cited development success story, with sustained strong growth and impressive poverty reduction. Thailand's economy grew at an average annual rate of 7.5% in the boom years of 1960 to 1996 and 5% during 1999 to 2005 following the Asian financial crisis. This growth created millions of jobs that helped pull millions of people out of poverty. Gains along multiple dimensions of welfare have been impressive. More children are getting more years of education, and virtually everyone is now covered by health insurance while other forms of social security have expanded. In recent years, economic growth slowed from 4.2% in 2018 to 2.4% in 2019. The key drivers of slowing growth were weaker demand for exports reflecting the impact of US-China trade tensions, slowing public investments, and a drought, impacting agricultural production. Key development challenges also pose a risk to Thailand's future growth if it wants to attain high-income status by 2037. These include weakness in education outcomes and skills matching, which risk future productivity and chances of the younger generation, and increasing spatial inequality, with remote areas falling behind in economic and welfare indicators. The largest economy in Southeast Asia, Indonesia has charted impressive economic growth since overcoming the Asian financial crisis of the late 1990s. Indonesia is classified as a newly industrialized country. Indonesia depends on domestic market and government budget spending and its ownership of state-owned enterprises. Today, Indonesia is the world's 4th most populous nation, the world's 10th largest economy in terms of purchasing power parity, and a member of the G20. Furthermore, Indonesia has made enormous gains in poverty reduction, cutting the poverty rate by more than half since 1999 to 9.78% in 2020. Prior to the COVID-19 crisis, Indonesia was able to maintain consistent economic growth, recently qualifying the country to reach upper middle income status. To respond to the shock of the COVID-19 pandemic, the government implemented emergency fiscal packages equivalent to 3.8% of GDP in 2020 and 4.2% of GDP in 2021 to deal with the health impact, provide relief to households and firms, and support the vaccine rollout and the recovery. The World Bank is supporting Indonesia's COVID-19 emergency response, including enhancing social assistance and healthcare systems, while also strengthening the resilience of the financial sector.